Welcome to the AB Dynamics 2024 full year results presentation. I'm James Routh, the CEO, and I'm joined today by Sarah Matthews-DeMers, our CFO. I'm going to be taking you through some highlights before Sarah takes you through the detailed financial performance, followed by a summary of ABD's transformation since 2020, demonstrating our track record. Following this, I'm excited to provide an illustration of our medium-term growth ambitions and the details of our value creation roadmap before wrapping up with a summary of FY24 and the outlook. During the year, and in line with our performance model, we delivered strong financial results with 10% growth in revenue and 22% growth in operating profit. Activity levels within our markets and customers have remained positive, with strong activity across all three of our sectors. As a core element of our strategy, new product development continues at pace and in line with the technology roadmap for our testing products and simulation markets, and we launched multiple new products to market. I'm very pleased to announce an initial contract win for ABD Solutions for £2 million for an automated mileage accumulation solution for delivery during FY25, with potential for further follow-on orders demonstrating the value of our investment in this technology accelerator. During the second half, we completed the acquisition of VTS, providing testing services in the US, with the integration progressing as planned. And after the period end, we acquired BoLab Systems, a German supplier of testing products, continuing our track record of successful inorganic growth. Finally, for the highlights, we are particularly pleased to achieve MSCI AAA rating, reflecting excellent progress on our sustainability strategy and strong governance. I'll now hand you over to Sarah to take you through the financial performance.
Thanks, James. I'm delighted to be able to present results that show the impact of the effort and investment put in over the last 5 years. We now have a strong and stable platform that's enabled us to deliver consistent revenue and profit growth, backed up by cash conversion. Revenue increased by 10%, with strong growth across testing products and services. Operating profit increased by 22% to 20.3 million. We've delivered operating margin expansion, up 170 basis points to 18.2%, a significant step towards our target of 20% plus margins. Despite an increase in the tax rate to 18.7% due to the increase in the UK rate, EPS has increased by 15% to 70 pence. We're increasing the dividend by 20%, reflecting our confidence in the business. Cash conversion of 115% and our rolling 3-year average cash conversion of 116% demonstrates that we are consistently able to turn these growing profits into cash. The order book of 30.3 million covers approximately 25% of FY25 expected revenue, reflecting the standard lead time for testing products of around 3 months. This, combined with additional sources of recurring revenue, such as renewal of licenses, gives good visibility into the first half of FY25. Revenue increased across all 3 sectors. Testing products, the group's largest sector, increased by 10%, or 8.4 million, with growth in robots and ADAS platforms supported by the increasing volume and complexity of testing on new vehicle models. Testing services saw a significant increase, with revenue up 29%, following a relaxation of 2023's pandemic restrictions and improved access to vehicles for testing. The acquisition of VTS contributed 1 million of revenue in the second half. Simulation revenue increased by 1%, with growth in simulation software, offset by lower revenue from simulator motion platforms due to the timing of order intake for these large capital items. The 3 simulators that were in build at the half year were delivered during the second half. Currency provided a small headwind, but had no material impact. Turning to profit, the volume increase dropped through to a 6.2 million increase in gross profit. Gross margin remained consistent with the previous year, with operational improvements in testing products and increased utilisation in US testing services, offset by a change in mix in simulation. The overhead increase reflects the impact of high levels of inflation seen at the beginning of the year. Delivery of 20 million of profit represents a step forward in operating margin to 18.2%, demonstrating continued margin progression. Our continued operating cash generation enabled us to invest 22 million in the future of the business through CapEx and acquisitions. The acquisition of VTS was funded through in-year cash generation, as was the final Ansible Motion payment. After returning cash to shareholders in the form of dividends, we had a significant net cash balance at the year end of 28.6 million, available to support strategic priorities. 4.2 million of this was used to fund the acquisition of Bolab after the year end. Moving on to the performance of each segment and starting with testing products. This segment includes driving robots and ADAS platforms and the large SPMM machines. The revenue growth was driven by the increased regulation and the increased complexity of testing, along with new product launches of the Launchpad Spin and additional soft targets. The increase in margin demonstrates the benefit of the investment in the business infrastructure and capability made in previous years, with operating leverage of higher volumes dropping through. Testing services includes our proving ground in California, which benefits from the same increases in regulation as testing products and on-road testing in China, as well as mileage accumulation and environmental testing in Michigan. As I mentioned, we saw strong recovery in US activity levels, with better availability of customer vehicles and new contract awards from the US regulator, NHTSA. The Chinese market returned to the pre-pandemic operating environment. The acquisition of VTS in half two performed in line with expectations, with the integration progressing as planned. Margin improvement was driven by the increase in volume. Simulation includes our simulation software, RF Pro, and driving simulator motion platforms. Following the 2023 acquisition of Ansible, the simulator product range is now fully aligned across the group's portfolio, and we saw strong growth in simulation software across the motorsport and OEM markets. We've also established agreements with technical partners in both software and motion platforms to deliver advanced simulation and testing capabilities. High-value simulator sales are individually material, and revenue recognition continues to be impacted by the timing of delivery, as does margin. The prior year benefited from a significant high-margin contract, which was not repeated in the current year. We thought it would be useful to set out how we've developed the business we inherited, to bring it to the point where we have a solid platform for the next period of growth, more of which from James later. As a reminder, here are the objectives we set out in 2019 and achievements against them. We have invested in R&D to enhance our product range, invested in people, infrastructure, skills and capabilities to right-size the business for the next phase of growth, and invested in geographical coverage to improve our support capability, which, along with the expansion of testing services, has led to an increase in recurring revenue to 45%. This, along with 6 acquisitions, has built out our customer offering. We've also built out our governance framework. The share price performance and key valuation metrics reflect the improvement in maturity and quality of the group. In short, we've done what we said we were going to do. As a result, we now have a business which has coverage, recurring revenue, resilience, and strong financial fundamentals of organic growth, improving margins, and strong cash generation. The graphs show our strong track record of improvement in our key metrics. Our ability to turn our profits into cash is demonstrated by the rolling 3-year average cash conversion of 116%. We've delivered this while investing in our operating capability and capacity to build robust foundations for further profitable growth. All of this puts us in a great place to continue to grow revenue, expand margins, and invest in further acquisitions. The key financial enablers behind this include Our capital allocation policy, which is unchanged, our first priority is to invest in organic R&D and CapEx and in ABD solutions, then M&A, and finally dividends. We aim to continue our cash conversion record at 100% through the cycle. Our strong balance sheet gives us flexibility, with £30 million of cash and a £15 million RCF facility. While we prefer to remain debt-free, our debt capacity at 2 times EBITDA is now approximately £50 million, which for the right acquisition we could use for a short period, then pay down from cash generation. All this is underpinned by our great people, with 200 qualified engineers and technicians, supported by an experienced team of professionals across sales, operations and finance. I'll now hand over to James to set out the next phase of growth and our medium-term objectives.
Thank you, Sarah. Having done the hard work over the last 5 years to position the business for further growth and put strong foundations in place, as Sarah described, I'm excited to present our value creation plan for the medium term. The graph demonstrates the compounding effect of delivering 10% organic revenue growth each year, expanding operating margins to 20% plus, investment in acquisitions continuing our disciplined approach against well-defined acquisition criteria, and this will deliver our medium-term aspiration of doubling revenue and tripling operating profit. It's important to note that this can be achieved without any contribution from ABD Solutions, which provides an opportunity for the cream on top, driving further incremental revenue and profit growth. I'll now describe each of these elements in turn on the next slides. So, how are we going to continue to deliver 10% organic growth each year? Our growth is supported by very long-term structural and regulatory growth drivers in 4 main areas. Firstly, consumer ratings, which are typically driven by NCAP, New Car Assessment Programme, with different regions at differing stages of implementation, but Euro NCAP leads the way and is most stringent. Improving safety technology means more complex equipment on cars to test. This leads to increasing number and complexity of tests, particularly with an expanded range of scenarios. This was previously mainly applied to passenger cars, but now expanded to trucks and other vehicle categories. Increased complexity and volume of testing leads to increased demand for our products and services. The second area is regulation, which includes NHTSA, the US regulator, where they have now issued a new federal standard for 2029, which is more stringent than EU standards, affecting not only US OEMs, but global OEMs selling into the US market. This was driven by an increasing number of injuries and fatalities in the US. There was also the UNECE General Safety Regulation, which mandates active safety equipment that must be included on all new cars sold in relevant countries, all of which need extensive development and certification testing. Japan also implements a similar regulation to UNECE, but also includes mandating the use of certain safety equipment for older drivers. And China is now also introducing standards for vehicle safety certification. The third area is the launch of new vehicle models, which in turn drives growth. In 2023, there are around 150 new model launches, all of which need development testing, type approval and certification in each region in which they are sold. Our testing products are used in the development process by R&D engineers and also in the certification process by technicians at the OEMs, Tier 1 suppliers and the test labs themselves. Speed to market and cost effectiveness is becoming increasingly important as the OEMs race to either acquire or maintain market share, which leads to increased use of simulation, allowing for faster, cheaper iterations of designs. New sensor technology and increasing automation of driving functions also increases demand for both testing and simulation products and services. And the final area, new powertrains. The emergence of new powertrains such as EVs, hybrids, hydrogen fuel cell and reduced emission fuels is a positive driver for our business. We are broadly powertrain agnostic, with our products being used to test all types of vehicles. The emergence of new powertrains drives new models, which all need testing and simulation. Recent news coverage regarding falling production volumes, particularly for EVs, has limited impact on our volumes, as we don't sell anything that goes into a production vehicle. We're selling into the R&D teams and the organisations independently conducting testing. Therefore, the number of models and complexity of tests has a far greater impact on our performance. As well as being powertrain agnostic, we're also OEM agnostic, in the sense we supply all major automotive OEMs, therefore providing protection against the current competitive environment between conventional manufacturers and Chinese EV makers. In summary, all of these market drivers are moving in the right direction to support sustainable double-digit revenue growth across our business. Our ongoing organic growth is also supported by high-quality, long-term customer relationships across all major automotive OEMs and many new entrants, as well as Tier 1 suppliers to the OEMs and service providers running proving grounds and NCAP test labs. This slide shows the multiple touch points with categories of customers across the ABD group through the development cycle from concept design to vehicle launch. At the concept design phase, OEMs may use our simulators, human factor studies, and our SPMM machines to benchmark the ride, handling, and safety systems of the new model. At the subsystem design phase, we support both OEMs and Tier 1 suppliers, simulating and testing subsystems early in the design cycle to optimize the design and minimize downstream risk of product failure. Once a prototype has been built, we provide track testing products and services for the OEMs and Tier 1s, as well as providing products for durability testing and conducting on-road testing services. Our products and services are also used by regulators and ratings bodies for type approval and NCAP consumer testing. A key part of our medium-term plan is to expand our operating margin, and the improvements we've made in the business in terms of culture and underlying systems and processes means we have a solid base to build from. To expand margin from the current 18% to above 20%, we will focus on 3 areas. Delivering operational gearing as we scale the business. The investment we've put in over the last 5 years means we have the capacity to deliver the next phase of growth without a corresponding step change in overheads. Simplifying the business, we're focused on improving our supply chain, rationalizing the number and quality of suppliers to obtain discounts and improve quality and efficiency, as well as rationalizing the number of product variations and combinations in the market. Standardizing our processes and procedures. We've already made many improvements in this area, but there's significant opportunity to streamline our manufacturing, improve design for manufacture, and drive the benefits from our ERP system. We've demonstrated a strong track record in delivering and implementing value-enhancing acquisitions. The market is fragmented and consists of a high number of small to medium-sized businesses which we screen against well-defined strategic and financial criteria. These are then filtered down into targeted approaches, which are usually off-market opportunities with vendors with whom we've built a relationship over a period of time, but are sometimes structured M&A transactions. Our sweet spot is bolt-on acquisitions with high gross margins in areas that we can add to our existing product or service capabilities and that can be sold through our existing international sales channels. We are looking for profitable, cash-generative businesses at reasonable multiples, which are EPS accretive, and we typically have several acquisition opportunities in various phases of the transaction process at any one time. Our approach to deal execution is highly disciplined and well-structured, allowing us to deliver acquisitions that are modelled and assessed on an acceptable level of return on investment. Our team is experienced in executing transactions and integrating the acquired businesses, as demonstrated by the 6 acquisitions we have completed in the last 5 years, the most recent being Bolab, completed shortly after year-end. We have an established approach to integration, and our organisation is structured so acquired businesses can be integrated into the appropriate segment. We have many examples of cross-selling post-acquisition. For example, VTS recently made its first sale into a major US OEM as a result of an introduction made from the wider ABD sales team. Ansible Motion had never sold into China pre-acquisition and has since been awarded 2 large simulator sales, and most recently, Bolab have sold systems into new customers in China through our existing routes to market. ABD Solutions was set up as the group's technology accelerator to leverage our core technologies and expand into adjacent markets. During the year, we've delivered the initial units of a product for construction vehicles, with a follow-on order placed by the customer for delivery during FY25. We have successfully won a new £2 million contract for a new mileage accumulation automation solution with the potential for follow-on orders. The ABD Solutions technology has opened up a new area of the automotive market that we could not previously access. We have several Phase 1 feasibility contracts for mining customers across several geographies. As expected, market penetration in this industry is slow, but we are making commercial progress, and it has significant potential once we start to gain traction. The mining pipeline has expanded during the year, and with the appointment of a new MD for ABD Solutions, who has extensive mining automation experience, we're gaining more commercial traction. As the product development is now largely complete and the future focus is on applications and commercialization, the engineering team is being merged with the wider group R&D function to benefit from our established processes for applications engineering and allow for more flexibility. We were very pleased with FY24 performance, having delivered strong strategic, financial and operational progress, double-digit revenue and profit growth, and operating margin improvement. We increased returns to shareholders and continued our track record of strong cash conversion. Our outlook for FY25 and beyond is positive. The long-term structural and regulatory growth drivers remain supportive of continued growth, underpinning our medium-term value creation plan. This, along with our operational improvement initiatives, support continued future margin expansion. Looking forward, we also currently have a good pipeline of acquisition opportunities, supporting continued inorganic growth alongside our compelling organic growth plans. We've made a positive start to the new financial year with strong order intake momentum during Q1, a positive book-to-bill ratio, and visibility now extends into the second half of the year. While we recognise that the current disruption to production volumes may slow OEM decision-making and potentially impact timing of order placement for large capital equipment, OEMs remain committed to R&D and hence continue to need our products and services. The board therefore expects FY25 to be slightly ahead of current expectations, further demonstrating our replicable model of investment returns. So, just to summarise our growth strategy and value creation plan. Our ambition is to double revenue and triple operating profit over the medium term through the compounding effect of 10% organic revenue growth, improving margins to 20% and beyond, converting these profits into cash with 100% cash conversion through the cycle, and a self-funded acquisition spend of £30 to £50 million per year. That concludes the presentation. Thank you for joining us.